While everyone was watching the Fed today, a document dropped this morning that quietly ended a decade-long war. The SEC, the same agency that spent years and millions of dollars trying to convince a federal court that XRP was a security, just published an official interpretation that classifies XRP as a digital commodity, not a security, not a gray area, a commodity. In writing, from the commission itself. And yet, XRP is barely moving. Most people see that and think, nothing matters, the market is broken, this is rigged. But if you think that, you are staring at the wrong thing entirely. And in the next 15 minutes, I'm going to show you exactly what you should be staring at, and why today, of all days, the signal has never been louder. Welcome back. I'm going to keep this tight and data forward, because today is a day for clarity, not noise. We have two major macro events colliding, the SEC's token taxonomy release and the FOMC interest rate decision. And most of the commentary you'll find online is getting both of them wrong. Let's fix that. Let me start with the hard truth. 90% of the people reacting to today's SEC announcement don't actually understand what just happened. And ironically, the ones celebrating the loudest understand it the least. So let's be precise. SEC Chair Paul Atkins this morning unveiled what's being called a token taxonomy and investment contract interpretation. This is not a tweet. This is not a press conference soundbite. This is a formal published interpretation from the commission itself, a legal document that defines 4 categories of crypto assets that are explicitly not securities. Those 4 categories are digital commodities, digital collectibles, digital tools, and payment stablecoins. And then, this is the line that matters. The chair said, only one crypto asset class remains subject to securities laws, namely digital securities, which are traditional securities that are tokenized. Think about what that means. The only thing the SEC can now regulate as a security is something that was already a security before it was put on a blockchain. Apple stock on a blockchain, security. XRP, not a security. It never was. And now the agency that spent years arguing otherwise has said so in writing. Stuart Alderati, Ripple's chief legal officer, said it plainly. We always knew XRP was not a security. Now the SEC has made it clear it is a digital commodity. But here's the concept most people are missing, and this is the foundation you need to understand everything else today. The battle over XRP's classification was never really about XRP. It was about jurisdiction. It was about which regulator, the SEC or the CFTC, gets to sit at the head of the table when the $150 trillion cross-border payments market migrates onto blockchain rails. That's what Gensler's enforcement by litigation strategy was actually doing. It wasn't protecting investors, it was a land grab, and it failed. What happened today is the SEC and CFTC drawing a clean jurisdictional line. The SEC keeps traditional tokenized securities. The CFTC gets digital commodities, which includes XRP, Bitcoin, and most of the functional crypto ecosystem. The Atkins statement is the SEC voluntarily stepping back from a space it was never supposed to control. That is the foundation. That is why this matters beyond the headline. Now let's talk about the math that the crowd is ignoring today. The first question people are asking is, why isn't XRP pumping? And to answer that, you need to understand the difference between a catalyst and a price trigger. Today's SEC announcement is a catalyst, a structural, foundational, irreversible catalyst. But price moves on surprise, and the surprise element of XRP's non-security status was already priced in the moment Gensler's SEC dropped its appeal. That was the market signal. Today is the legal documentation of what the market already priced. Now here is the math that does matter today. Cross-border payment flows run at approximately $150 trillion annually. Daily foreign exchange settlement, just the currency conversion layer, runs at $7.5 trillion per day. Inside that system, financial institutions maintain what are called nostro and vostro accounts, pre-funded liquidity pools sitting idle in correspondent banks around the world. Estimates put the capital locked in that system at roughly $27 trillion. That is dead capital, earning nothing, sitting in a pipe, waiting. XRP's design, the XRPL's 3 to 5 second settlement, the bridge currency mechanic, is built to eliminate that locked capital. Not to reduce it, to eliminate it. Now do the math. If XRP captures even 1% of the liquidity efficiency unlock from that $27 trillion nostro-vostro problem, that's $270 billion in institutional utility demand, against a circulating supply of approximately 55 to 57 billion tokens. At current prices, that math produces a liquidity requirement that the current price cannot support. Think about that logically. Higher XRP price means fewer tokens required to move the same dollar value. Fewer tokens required means less market disruption per transaction. Less market disruption means institutions can execute at scale. The price of XRP is not just a number. It is a functional variable in the efficiency of global settlement. This isn't a moonboy fantasy. It is a design requirement. The market will eventually reflect that, not because of hype, but because the infrastructure being built demands it mathematically. While retail investors are refreshing price charts and asking why XRP isn't at $10 today, let me show you what the smart money has been quietly doing. Ripple, the company, not the token, has been executing an acquisition strategy that doesn't make headlines the way price movements do, but tells you everything about where institutional confidence sits. Hidden Road, Standard Custody. These are not crypto-native plays. Hidden Road is a prime brokerage that serves hedge funds and institutional clients. Standard Custody is a regulated digital asset custodian. Ripple isn't building for retail. Ripple is building the institutional rails, the plumbing that large capital flows through before it ever becomes visible to the retail market. Ask yourself this: does a company that believed its core asset was legally at risk spend hundreds of millions acquiring regulated financial infrastructure? Absolutely not. These acquisitions were happening during the litigation. That's not desperation, that's positioning. And then look at the regulatory posture globally. The Bank of Japan has been piloting CBDC settlement infrastructure. The Monetary Authority of Singapore has been running Project Guardian, cross-border tokenized asset settlement. The IMF has been publishing frameworks for multi-currency digital reserve systems. These are not retail-facing projects. These are sovereign-level conversations about the future architecture of global finance. And XRP sits at the intersection of every single one of them, not because of marketing, because of speed, finality, cost, and the existing network of on-demand liquidity corridors already operational in over 40 markets. Meanwhile, and this is the contrast that should tell you everything, while institutions are signing NDAs, building integrations, and acquiring regulated entities, the retail crowd is asking why the price isn't up today. Patience is not passivity. Patience is the strategy. So what is the trigger? What's the actual event that closes the window for accumulation? Let me be clear about what's on the immediate horizon. First, the FOMC decision today. The probability of a rate hold is priced above 97%. But what matters is not the decision. It's the forward guidance. If Chair Powell signals even a modest shift toward rate cuts in the back half of 2025, that is a liquidity expansion signal. Risk assets move on liquidity. That is the macro tailwind that has been missing since mid-January. Second, the Clarity Act. Here's the question people are now asking. If the SEC just gave us regulatory clarity administratively, do we even need the Clarity Act? And the answer is yes. Here's why. Administrative interpretations can be reversed. A new administration, a new commission chair, a new political wind, and that document disappears. A law cannot disappear that way. It requires another act of Congress. When the Clarity Act passes, and according to Senate Banking Chair Tim Scott, the stablecoin framework is being drafted this week, which is the prerequisite. It codifies everything the SEC announced today into something that survives political cycles. That is the moat. That is the permanence. Third, ETF flows. XRP spot ETF applications are live. When approvals come, not if, the capital that has been sitting on the sidelines behind compliance walls flows in. That is not a trickle. That is institutional allocation. The window is not open forever. The fuse is lit. The question is only whether you recognized it before the detonation or after. Here's the thing about structural shifts. They don't announce themselves with fireworks. They look boring until the moment they don't. Exchange reserves for XRP are at multi-year lows. On-chain data from CryptoQuant confirms that the tokens are moving off exchanges, not onto them. That is accumulation behavior, not distribution behavior. Ripple's escrow releases, 1 billion tokens per month, are being relocked at a rate that keeps effective net supply growth near zero. The circulating supply has not meaningfully expanded in over a year. Fixed supply, declining exchange reserves, expanding utility infrastructure, growing regulatory clarity, institutional acquisition activity. Every one of those variables points in the same direction. The crowd sees a flat chart and concludes nothing is happening. The informed understand that flat charts during structural accumulation phases are a gift. Once the price moves, the accumulation phase is over, and you can only buy at these prices while the crowd is still distracted. Today, the SEC drew a line. XRP is on the right side of it, officially, legally, permanently. Today, the FOMC will speak, and when Powell opens the door to rate cuts, risk assets will feel it. Today, the foundation of a multi-trillion-dollar settlement infrastructure continues to be built quietly, without fanfare, while the crowd waits for a number on a chart to give them permission to believe in what the architecture has already confirmed. The question is never, when will it happen? The question is always, will you be positioned when it does? I am the calm analyst. The math doesn't lie, and the system is almost complete. If this breakdown gave you clarity today, smash the like button, subscribe if you haven't, and drop a comment below telling me, do you think the Clarity Act still matters now that the SEC made its move? I want to see who's actually been paying attention. I'll see you after the Fed speaks tonight. Stay patient, stay rational, and as we always do, we don't wait for the future, we plan for it.